You think your money is safe. You think the FDIC has your back. You think that $250,000 insurance limit means something. Let me tell you what I found this morning at 4:47 a.m. when I pulled the Federal Deposit Insurance Corporation's own quarterly report. And I need you to understand something before we go any further. This is not speculation. This is not conspiracy theory. This is their data, published by them on their website. And what I am about to show you is a mathematical crime scene. The FDIC Deposit Insurance Fund, as of Q4 2025, holds $128.2 billion in reserves. That number is public. You can verify it right now. Go to fdic.gov/reports/quarterly banking profile. It is right there in black and white, $128.2 billion. Now, let me show you the other number. Total insured deposits in the United States banking system as of the same quarter, $10.5 trillion, not billion, trillion, with a T. So let's do the math right here, right now, because this is where it gets obscene. $128.2 billion divided by $10.5 trillion equals 0.0122. That is 1.22%. The FDIC has 1.22% of the capital required to honor the insurance they promise you. Not 10%, not 50%, 1%. Your deposits are 99% uninsured by actual liquid reserves. And that is, if we are being generous and assume that $128.2 billion number is real cash and not treasury bonds, they would have to dump into a collapsing market to raise liquidity, which it is bonds. Illiquid bonds, which means in a real crisis, that 1.22% coverage ratio drops to functionally zero. But it gets worse, because I am looking at the total deposit base, not just insured. Total deposits in U.S. commercial banks as of December 2025, $18.3 trillion. That is checking accounts, savings accounts, money market accounts, all of it. And the FDIC Insurance Fund has $128 billion to backstop $18.3 trillion in total deposit liabilities. That is a 0.7% reserve ratio against the real systemic exposure, less than 1%. So when you hear Janet Yellen or Jerome Powell stand at a podium and tell you the banking system is sound, I want you to remember that number. 0.7%. That is not a reserve. That is a rounding error. That is a joke. And the punchline is you. Now, before the algorithm buries this video in the next 90 seconds, I need you to do something for me. I need you to hit that like button right now. Not later. Right now. Because the mainstream financial media is not going to cover this. CNBC is not going to walk you through the FDIC's own quarterly data and show you that the entire deposit insurance system is a mathematical fraud. Bloomberg is not going to calculate the reserve ratio on live television and tell you it is less than 1%. Why? Because their biggest advertisers are the banks. JP Morgan Chase does not pay for commercial time, so you can hear that your deposits are effectively uninsured. So the only way this information breaks through the censorship wall is if you force it onto the algorithm's radar by smashing that like button. Do it now. Boost the signal. Because what I am about to show you next is going to make you question every dollar you have sitting in a checking account right now. Let me take you back to March 10th, 2023. Silicon Valley Bank collapses, the 16th largest bank in America, gone in 48 hours. And do you remember what happened? The FDIC stepped in. They announced they were covering all deposits, not just the insured $250,000, all deposits. Businesses with $50 million in operating accounts. Venture capital firms with $200 million on deposit, all of it, fully insured retroactively, and everyone cheered. Crisis averted. The system works. Except that was a lie. Because the FDIC did not have the money to cover those deposits. What they did, and you can verify this in the Federal Register notice published March 13, 2023, was invoke the systemic risk exception, which is a legal loophole that allows the FDIC to tap the U.S. Treasury for unlimited emergency funding. Translation, they used taxpayer money. They printed it. They did not use the insurance fund. They could not. Because the insurance fund at the time had $128 billion, and Silicon Valley Bank alone had $175 billion in deposits. The math did not work. So they bypassed their own system and went straight to the Treasury's printing press. And that should tell you everything you need to know about the real solvency of the FDIC. But let me give you another example, because 1 is a fluke, 2 is a pattern, 3 is a system. March 12th, 2023, Signature Bank, shut down by New York state regulators. Total deposits, $88.6 billion. Insured deposits, less than $10 billion. The FDIC once again invoked the systemic risk exception, covered all deposits, used the Treasury backstop. And then 2 months later, First Republic Bank, May 1st, 2023, $233 billion in assets, collapsed, seized by regulators, sold to JP Morgan Chase in a closed-door weekend deal. And once again, the FDIC guaranteed all deposits, not with their insurance fund, with the Federal Reserve's emergency lending facility, which is just a fancy term for printing money. 3 banks, 3 systemic bailouts, 0 actual insurance fund deployment, and the FDIC's reserve ratio today is exactly where it was before the crisis, at 1.22%. They learned nothing. They fixed nothing. They just papered over the problem with freshly printed dollars and told you the system is stable. Now I need you to understand the legal structure of what a bank deposit actually is, because this is where it gets dark. When you deposit money into a checking account, you think you are putting your money in a safe. You think the bank is holding it for you, but legally, that is not what happens. Under the Uniform Commercial Code, which governs all banking transactions in the United States, a deposit is classified as an unsecured loan to the bank. You are the lender. The bank is the borrower. And when you swipe your debit card or write a check, you are not withdrawing your money. You are calling in a debt the bank owes you, which means if the bank goes bankrupt, you are not a depositor. You are a creditor. You are in line with every other unsecured creditor waiting for the bankruptcy court to liquidate the assets and pay out pennies on the dollar. And this is not theoretical. This is codified in the Dodd-Frank Wall Street Reform Act of 2010, Title II, Section 210, the Orderly Liquidation Authority, which gives the FDIC the power to seize a failing bank, wipe out shareholders, convert bonds to equity, and most importantly, confiscate deposits above the $250,000 insurance limit to recapitalize the bank. That is called a bail-in, and it is legal. It is the law. And it has already happened in the Western banking system. Cyprus, 2013. The banking system collapses under the weight of Greek sovereign debt exposure. The Cypriot government, the European Central Bank, and the International Monetary Fund negotiate a bailout. But there is a condition. Depositors with more than 100,000 euros in Cypriot banks must contribute to the rescue. How much? 47.5%. They confiscated 47.5% of deposits above the insurance threshold to recapitalize the banks. No vote, no warning. You went to bed on a Friday with 200,000 euros in your account. You woke up Monday morning with 105,000 euros. The rest was gone, converted to worthless bank equity. And the European Union called it a successful resolution, not theft. A resolution. That is the template. That is the precedent. And Dodd-Frank, Section 210, gives the FDIC the exact same authority on U.S. soil. Now let me show you why this is not just a hypothetical risk, why this is an active, present-tense threat. The U.S. banking system, as of Q4 2025, is sitting on $620 billion in unrealized losses. That number comes from the Federal Reserve's own quarterly report on bank balance sheets. $620 billion, and that is just the marked-to-market loss on their bond portfolios. Because when the Federal Reserve raised interest rates from 0% in 2021 to 5.5% by 2023, every long-duration Treasury bond and mortgage-backed security the banks were holding dropped 20, 30, 40% in value. A 10-year Treasury bond yielding 1.5% that a bank bought in 2020 for $1,000 is now worth $700 in the open market because new 10-year Treasuries are yielding 4.5%. That is how bond math works. When rates go up, bond prices go down, and the banks are holding trillions of dollars in these underwater bonds. But here is the magic trick. As long as they do not sell those bonds, they do not have to recognize the loss. They can classify them as held to maturity and carry them at face value on their balance sheet, which makes the bank look solvent on paper even though they are functionally insolvent in reality. And that works great until depositors start pulling their money out. Because then, the bank has to sell those bonds to raise cash. And the moment they sell, the loss becomes real. The capital vanishes, and the FDIC steps in. This is exactly what killed Silicon Valley Bank. They had $120 billion in bonds, mostly long-duration treasuries and mortgage-backed securities, bought at the peak of the bubble in 2020 and 2021 when rates were zero. And when their venture capital depositors started withdrawing funds in February 2023, SVB had to sell $21 billion in bonds to meet redemptions. And they realized an $1.8 billion loss on that sale, which wiped out their capital buffer, which triggered a bank run, which ended with the FDIC seizing the bank 48 hours later. That is the death spiral. And every regional bank in America with a heavy bond portfolio is one bad quarter away from the same fate. And there are a lot of them. The Federal Reserve's data shows that U.S. banks are holding $4 trillion in Treasury and agency securities as of December 2025, and a huge chunk of that is underwater. We are talking about hundreds of billions in unrealized losses spread across hundreds of institutions. All it takes is one spark, one depositor panic, one liquidity event, and the cascade begins. And this brings me to the real crime, because the Federal Reserve and the FDIC know this. They have the data, they publish the data, and they are doing nothing to fix it. Why? Because there is no fix. The only way to recapitalize the banking system is to either let interest rates crash back to zero, which would destroy the dollar and ignite inflation, or let the banks fail and bail them out with printed money, which also destroys the dollar and ignites inflation. They are trapped. Checkmate. And so they are running out the clock, praying that nothing breaks before they can hand the crisis off to the next administration. That is the game. And you are the collateral. Now I want to stop right here for a second, because I need to talk to you about something important. The information I just gave you. The FDIC reserve ratios, the unrealized losses, the bail-in laws. None of that is going to show up on CNBC tonight. You are not going to see Jim Cramer calculate the 1.22% insurance fund coverage and tell his audience their deposits are at risk. Why? Because the mainstream financial media is funded by the banks. JP Morgan Chase, Bank of America, Citigroup, they are the ones buying the commercial time. They are the sponsors. And you do not bite the hand that feeds you. So the truth gets suppressed. It gets memory holed. It gets buried under 1,000 fluff pieces about stock buybacks and earnings beats. And the only way this information reaches the public is through independent channels like this one. Which means we are 100% reliant on you. Not advertisers. Not sponsors. You. And if this data is valuable to you, if it helps you understand the risk your family's wealth is sitting in right now, I need you to hit that super thanks button below this video. You will see a little heart icon underneath. That is the super thanks feature. It allows you to directly support this research with a one-time contribution. It costs less than a movie ticket, but it keeps this channel alive. It keeps me digging through Federal Reserve reports at 4 inches the morning so I can bring you the data Wall Street does not want you to see. And if you want to go a step further, if you want to join the core group of people fighting back against the financial censorship complex, click the join button next to subscribe. That makes you a channel member. You get early access to videos. You get members-only live streams where we go even deeper into the data. And most importantly, you become part of a community that refuses to be lied to. It costs less than a coffee subscription, but it sends a message. It tells YouTube's algorithm that this content matters, that the truth has an audience. So if you can, hit that super thanks button. Or join as a member. Or both. Because without you, this channel does not exist. And without this channel, you are stuck with whatever narrative the banks want to feed you. All right? Let's get back to the crime scene, because I want to show you exactly where this leads, and that is silver. Physical silver, the anti-bank asset, the counterparty risk-free store of value. And I'm going to explain why, mathematically, structurally, systemically, silver is the escape hatch when the FDIC's 1.22% reserve ratio finally collapses under its own weight. First, let's define the problem. Counterparty risk. That is the risk that the other party in a financial transaction fails to honor their obligation. When you have money in a bank, you have counterparty risk. The bank is your counterparty. You are trusting them to give you your money back when you ask for it. And as we just established, that trust is backed by a 1.22% reserve ratio and a legal structure that classifies you as an unsecured creditor in a bankruptcy. That is a lot of counterparty risk. Now contrast that with physical silver, a 1-ounce silver coin sitting in your safe. Who is your counterparty? No one. The silver does not depend on a bank staying solvent. It does not depend on the FDIC having enough money in the insurance fund. It does not depend on Congress authorizing a bailout. It just is. It is an element. Atomic number 47. It has been valuable for 5,000 years, and it will be valuable for the next 5,000 years because it is scarce, it is useful, and it cannot be printed. That is the difference. That is why silver is the anti-bank asset, because it eliminates counterparty risk entirely. Now let me show you the math on what happens when that understanding goes mainstream. When the public realizes their bank deposits are effectively uninsured and they start pulling cash out to buy physical assets, we do not have to speculate. We have historical precedent. Let's go back to 1933. Franklin Delano Roosevelt, newly inaugurated, facing a banking crisis. Over 5,000 banks had failed in the previous 3 years. Depositors were panicking. And people were converting their dollars into gold at the Federal Reserve's window as fast as they could. Because gold was money. And paper dollars were just a claim on gold. And when people stopped trusting the paper, they demand the metal. So what did FDR do? Executive Order 6102. April 5th, 1933. He made it illegal for U.S. citizens to own gold. You had until May 1st to turn in your gold coins, your gold bars, your gold certificates to the Federal Reserve in exchange for $20.67 per ounce in paper money. And if you did not comply, you faced a $10,000 fine and 10 years in prison. That is how scared they were of a flight to hard assets. And after they confiscated the gold, after they got it all out of private hands and into the government's vaults, you know what they did? They revalued gold from $20.67 to $35 per ounce. A 69% devaluation of the dollar overnight. They stole the gold at $20. They repriced it at $35, and the public got robbed. That is the playbook. And it works because physical assets have inelastic supply. You cannot print more gold. You cannot print more silver. So when demand surges, the price explodes. Now, let's fast forward. August 15th, 1971, Richard Nixon. The Nixon shock. The U.S. officially closes the gold window. Foreign central banks can no longer convert their dollars into gold at the Federal Reserve. The dollar is now a pure fiat currency, backed by nothing but the promise of the U.S. government. And what happened to gold? It went from $35 per ounce in 1971 to $850 per ounce by January 1980. A 24x return in less than 9 years. Why? Because the world lost confidence in the dollar, and when you lose confidence in paper, you buy metal. That is the flight to safety. That is the liquidity cascade out of financial assets and into physical assets. And silver did the same thing. Silver went from $1.50 per ounce in 1971 to $50 per ounce in January 1980, a 33x return, because silver is gold's little brother. It tracks gold's moves but with more volatility, more beta, and when gold runs, silver sprints. And then 2008, the financial crisis. Lehman Brothers collapses, AIG gets bailed out, the Fed drops rates to zero, and launches QE1. $1.7 trillion in quantitative easing in the first round alone. Money printing, digital money printing, expanding the Fed's balance sheet from $900 billion to $2.2 trillion in 18 months. And what happened to gold? It went from $800 per ounce in October 2008 to $1,900 per ounce by September 2011. A 137% gain in less than 3 years. And silver? Silver went from $9 per ounce in October 2008 to $49 per ounce in April 2011, a 444% gain. That is what happens when the public loses faith in the banking system and rotates into hard assets. The metals go parabolic. So now let me bring this forward to today, to right now, to the FDIC sitting on a 1.22% reserve ratio, to the banks holding $620 billion in unrealized losses, to the Dodd-Frank bail-in laws giving the government legal authority to confiscate your deposits, to the precedent set in Cyprus in 2013, to the historical pattern of governments debasing currency and seizing private wealth when the system breaks. What do you think happens when the next bank fails? When the next Silicon Valley Bank or First Republic event hits? When depositors wake up and realize the FDIC cannot cover their accounts? Where does that money go? It does not stay in the bank. It cannot. Because the bank is the risk. So it flows out. And it flows into assets that have no counterparty risk. And the two biggest counterparty risk-free assets on planet Earth are gold and silver. That is the trade. That is the setup. And the price action is already starting. Let me give you the current data. As of today, January 13th, 2026, silver is trading at $32.50 per ounce on the COMEX futures market. That is the paper price. The price you see on the screen. But if you try to buy physical silver today, right now, from a dealer, you are not paying $32.50. You are paying $37, $38, maybe $40 depending on the product. That is a $5 to $7 premium over spot, a 20% premium, and that premium has been widening for the last 18 months. Why? Because there is a shortage, a physical shortage. The U.S. Mint, which produces the American Silver Eagle coin, the most popular silver bullion product in the world, has been rationing production since mid-2024. They cannot keep up with demand. They are allocating coins to dealers on a quota system, and dealers are selling out within hours of receiving inventory. That is not a normal market. That is a supply crunch. And it is happening while the paper price is still under $35. Imagine what happens when the paper price catches up to the physical reality. When the COMEX market realizes there is no silver available to deliver against the futures contracts, that is the gamma flip. That is the moment when the algo-driven paper market collides with the physics of supply and demand, and the price goes vertical. Now let me show you the supply-demand fundamentals, because this is where it gets absolutely criminal. Global silver mine production in 2025 was approximately 840 million ounces. That number comes from the Silver Institute's World Silver Survey. 840 million ounces mined. Now let's look at demand. Industrial demand alone, things like solar panels, electronics, electric vehicles, medical applications, was 550 million ounces. Investment demand, coins and bars, was 220 million ounces. Jewelry and silverware, another 180 million ounces. Total demand, 950 million ounces. That is a 110 million ounce deficit. Supply is less than demand. So where is the extra silver coming from? Recycling and above-ground inventories. The COMEX warehouses, the London Bullion Market Association vaults, the Shanghai Futures Exchange. But here is the problem. Those inventories are finite, and they are shrinking. COMEX registered silver inventories, which is the silver available for delivery against futures contracts, were at 70 million ounces in January 2025. As of today, they are at 48 million ounces. That is a 31% decline in 1 year, and at the current rate of drawdown, the COMEX will be out of registered silver by Q3 2026, less than 9 months from now. And when that happens, when there is no silver left to deliver, the paper price has to converge with the physical price, and the physical price, as I just showed you, is already $7 above the paper price. That is a 20% snapback waiting to happen. And that is before we factor in the panic buying that will occur when depositors realize their bank accounts are not insured. So let's do the math. Let's model what a flight to silver looks like when the FDIC's 1.22% reserve ratio finally gets exposed. Let's say 5% of US depositors decide to pull $10,000 out of their bank accounts and buy physical silver. Just 5%. Not 50%, not 20%, 5%. There are roughly 130 million households in the United States, and 5% is 6.5 million households. 6.5 million households times $10,000 equals $65 billion in purchasing power. Now divide that by the current silver price of $32.50 per ounce. $65 billion divided by $32.50 equals 2 billion ounces of silver. 2 billion ounces. And remember, global mine production is only 840 million ounces per year. And the COMEX has 48 million ounces in registered inventory. Where is 2 billion ounces of silver going to come from? It is not there. It does not exist. So what happens? The price has to rise until demand is destroyed. And how much does the price have to rise? Well, if the price doubles from $32.50 to $65, you cut the ounces demanded in half, from 2 billion ounces to 1 billion ounces. But 1 billion ounces is still more than annual mine production, so the price has to go higher, to $100 per ounce. At $100, you cut the ounces demanded to 650 million ounces. That is below annual mine production. That is where the market clears. That is the equilibrium, $100 per ounce. And that is just 5% of depositors moving $10,000 each. If 10% move, if 20% move, if the average moves $20,000 instead of $10,000, you are looking at $200, $300, $500 silver, because the supply is fixed and the demand is theoretically unlimited when people panic. And I want you to understand something. This is not a prediction. This is not hopium. This is not me trying to pump the price of silver so I can sell you something. I do not sell silver. I am not affiliated with any dealer. I am not making a commission. I am showing you the math. I am showing you the FDIC's own data. I am showing you the reserve ratios. I am showing you the unrealized losses. I am showing you the supply deficits. And I am asking you to do the only rational thing a person can do when they realize their bank deposits are sitting on a 1.22% insurance backstop. Get your wealth out of the danger zone. Get it into your hands. Get it into an asset that does not depend on the FDIC, the Federal Reserve, Congress, or any other institution keeping their promises. Because history shows they do not keep their promises. 1,933, they confiscated gold. 1,971, they closed the gold window. 2008, they bailed out the banks with printed money. 2013, Cyprus confiscated deposits. 2023, they invoked the systemic risk exception to cover SVB's uninsured deposits with taxpayer funds. Every single time the system breaks, the public gets robbed. Every single time. And the only people who escape are the ones holding physical assets outside the banking system. Now, let me address the objection I know some of you are thinking. But John, silver is volatile. It crashed from $50 in 2011 to $14 in 2020. Why would I put my money into something that can drop 70%? And that is a fair question. So, let me give you the answer. Silver crashed from $50 to $14 because the Federal Reserve raised interest rates and stopped printing money. In 2013, the Fed started talking about tapering QE. They signaled they were going to slow down the money printing, and risk assets sold off. Precious metals sold off. Silver got hit the hardest because it is the most volatile. But here is the thing. The Fed is not raising rates anymore. They are at 5.5% right now. And the banking system is sitting on $620 billion in unrealized losses because of it. They cannot raise rates higher without blowing up more banks. And they cannot keep rates here forever because the government's interest expense on the $36 trillion national debt is now over $1 trillion per year. That is more than the defense budget. So what are they going to do? They are going to cut rates. They are going to restart QE. They are going to print money again because that is the only tool they have left. And when they do, silver is going to $100. And this time, it is not going to crash back to $14. Because this time, the public is not going to trust the banks. This time, the depositors are going to remember SVB. They are going to remember the 1.22% reserve ratio. They are going to remember that their deposits are legally classified as unsecured loans. And they are going to keep their wealth in physical assets. That is the structural shift. That is the regime change. And silver is the beneficiary. So let me tell you exactly what you need to do. Step 1. Go to your bank. Not tomorrow, not next week, today. Pull out enough cash to cover 3 to 6 months of expenses. Keep it in a safe at home, not in the bank, at home. Because if there is a bank run, if there is a bail-in, if the FDIC invokes the orderly liquidation authority, you will not have access to your account. The bank will freeze withdrawals. And you will be stuck waiting for the bankruptcy court to sort it out. So get your operating capital out now. Step 2. Take everything above your 3 to 6 month cash buffer and convert it into physical assets. Silver, gold, Bitcoin if you understand the technology. But physical silver is the easiest, most accessible, most liquid option for most people. You can walk into any coin shop in America and buy silver eagles for $38 each. You do not need a broker. You do not need an account. You do not need to understand blockchain. You just hand them cash and they hand you silver. Step 3. Store it at home, not in a bank safe deposit box. At home, because if the bank goes under, you lose access to the safe deposit box. It becomes part of the bankruptcy estate. Home safe, bolted to the floor, hidden. That is where your wealth needs to be. Outside the banking system, outside the reach of the FDIC's bail-in authority, outside the reach of Executive Order 61022, if they decide to go down that road again. And I know some of you are thinking this sounds extreme, this sounds paranoid, this sounds like tinfoil hat survivalist nonsense, but let me ask you a question. Is it more extreme to take your wealth out of a bank with a 1.22% insurance reserve ratio, or to leave it there and hope nothing goes wrong? Is it more paranoid to own an asset with 5,000 years of history as a store of value, or to trust a system that has failed repeatedly in the last 100 years? Is it more extreme to prepare for a banking crisis, or to get caught unprepared when it happens and lose 47? 5% of your deposits like the people in Cyprus? You tell me. Because from where I am sitting, looking at the FDIC's own quarterly data, looking at the unrealized losses on bank balance sheets, looking at the supply deficit in the silver market, the only irrational thing to do is nothing. The only crazy response is to assume the system is fine. Because the system is not fine. The system is a 1.22% reserve ratio away from collapse. And that is not my opinion. That is their math. Now I want to talk about one more thing before we wrap up, and that is the timeline. Because I do not know when this breaks. I do not know if it is next month, next quarter, next year. What I know is that the structural vulnerabilities are in place. The FDIC is undercapitalized. The banks are holding hundreds of billions in unrealized losses. The silver market is in a supply deficit. And depositor confidence is fragile. All it takes is one catalyst, one regional bank failure, one headline, one moment where the public realizes the FDIC cannot cover the deposits, and the cascade starts. And once it starts, it moves fast. Silicon Valley Bank went from fine to seized by regulators in 48 hours. Lehman Brothers went from investment-grade rating to bankruptcy in 72 hours. These things do not happen slowly. They happen in a flash. And if you are waiting for CNBC to tell you it is time to get your money out of the bank, you are already too late. Because by the time the mainstream media admits there is a problem, the banks have already frozen withdrawals and the FDIC has already invoked the bail-in authority. That is how it works. The information moves faster than the system's ability to respond, and the people who survive are the ones who saw it coming and acted early. So I am telling you now, the FDIC's reserve ratio is 1.22%. Your deposits are 99% uninsured by actual liquid capital. The banks are holding $620 billion in unrealized losses. The silver market is in a supply deficit, with COMEX inventories dropping 31% in the last year. And every single historical precedent shows that when depositors lose confidence in the banking system, they rotate into physical assets and the prices go parabolic. Gold went 24x from 1,971 to 1,980. Silver went 33x. Gold went up 137% from 2008 to 2011. Silver went up 444%. And this time, the setup is worse. This time, the FDIC's reserve ratio is half of what it was in 2008. This time, the unrealized losses are double. This time, the precedent of bail-ins has already been set in Cyprus. This time, the public knows the government will not let the banks fail. They will just take the depositors' money to keep them afloat. That is the difference. That is why this cycle is going to be bigger than the last one. And that is why silver is going to $100, not as speculation, as math. And before you go, I need to say this one more time. This channel exists because of you. We do not take bank sponsorships. We do not run ads for JP Morgan Chase. We do not get paid to tell you the system is fine. We get paid by you to tell you the truth. And if this information is valuable, if it changes your perspective on where to hold your wealth, if it protects your family from the next banking crisis, I need you to support this work. Hit that super thanks button below the video. It is the little heart icon, one-time contribution, costs less than a dinner out, but it keeps this research coming. Or, if you want to go deeper, if you want members-only content, early access to videos, live Q&A sessions where we break down the data in real time, click the Join button. Become a channel member. It is less than a streaming subscription, but it makes you part of the team that is fighting back against the financial media's narrative control. We are not going to let them memory hole this. We are not going to let them pretend the FDIC's 1.22% reserve ratio is normal. We are not going to let them ignore the $620 billion in unrealized losses. We are going to keep shining a light on the crime scene, and we need you with us. So hit that super thanks, join as a member, or both. And let's make sure this data reaches every person who needs to see it before the next bank fails. I do not know how much time we have left. I do not know if we have months or weeks. What I know is that the math is not on the FDIC's side. The structure is not on the depositor's side. And the only rational move is to get your wealth out of the crosshairs. Get it into silver, get it into gold, get it into assets that do not depend on the promises of insolvent institutions. Because those promises are not worth the paper they are printed on. And when the music stops, when the FDIC's 1.22% reserve ratio finally gets stress tested by a real crisis, you do not want to be the person standing in line at the bank hoping they have enough money to honor your withdrawal. You want to be the person with the silver coins in the safe. That is the difference between getting robbed and getting out. And the choice is yours. Right now, today, before the headlines hit, before the bank freezes withdrawals, before the FDIC invokes Section 210. Get out, get into silver, and get ready, because the crime scene is getting bigger, and the only question is whether you are going to be a victim or a survivor.